I mean, this could be what triggers a massive kind of recession, if not worse, is that when...
Hello everyone and welcome to the Daily Crypto. We are back with yet another video, and this time we are joined by Gareth Soloway. But before we get started with the interview, let's take a look at the Fear and Greed Index for today. As of recording this video, it is sitting at 24, up slightly from yesterday's 20. Currently Bitcoin and Ethereum are trading for 19,700 and 1,334 respectively. With that being said, let's continue with the video.
There's no doubt that there's panic in the markets, but per the VIX, we haven't hit the levels where I would say there's a market bottom yet, right? So I've been consistently saying, yes, you're gonna get bounces when you get these big sell-offs, 2%, 3%, you get that kind of mid-level panic that triggers a bounce, but by no means is the market at a near bottom yet.
Gareth believes the markets haven't bottomed yet, even though we are seeing markets slightly up today. This is because it is common for the market to give fake bounces to trap investors and trick them into believing that this will be the end of the bear market.
You know, you still have a Fed that's aggressively hiking. As of now, we'll see what the CPI data is coming up, but for the most part, the Fed is hiking. We have an economy that's going to slow down, and I think that's to be honest, that's one of the biggest concerns I have, and this is kind of shocking. This will be shocking to people, but you have $1 trillion in savings that consumers accumulated over COVID, right? And so the Fed is saying, oh, look at these jobs numbers. They're still very, very strong. People are still spending. The consumer's still doing well. So we have to continue to hike rates. Problem is, consumers are going to run out of that money that they saved probably by mid-next year. And my biggest fear, and this is this could be what triggers a massive kind of recession, if not worse, is that when they run out of money and the Fed has just hiked and hiked into it, there's going to be a cliff dive in the economy.
Gareth is still of the opinion that we haven't seen the bottom yet and things could get much worse from here. According to the data by the Fed, consumers have almost $1 trillion in their savings account. Now the problem is that if the Fed continues to hike interest rates, at some point people will be forced to use up their savings and will eventually go fully broke. Gareth thinks this could happen by next year and could be the cause of a big financial crisis.
A recession can be mild, right? I mean, you could have, okay, it's a little minor recession. I mean, even the Fed has said, hey, we don't care if we push the economy into a recession. But a cliff dive, that's where you have unemployment going to 5, 7, 8, 9, 10%. And that's where you get in trouble, where the Fed then has to start lowering rates instead of just going to neutral where they're not hiking anymore. And potentially down the line, I do worry that it's going to get so bad that even with 4% inflation, you still could see a point where in like a year, 2 years from now, the Fed has to actually start QE again.
A small recession is not that big of a deal because it is actually healthy for sustainable growth. However, a cliff dive is always catastrophic. This is because it causes unemployment to go through the roof and in turn destroying the whole economy for a very long time.
All right, so technically per GDP, you can make a case for that, right? But I think a lot of people have argued that it's not a true recession because you have to deal with the COVID aftermath and then what's going on with that kind of stuff. So you had COVID kind of affecting GDP for a while, and the jobs numbers have been strong. But again, I would strongly encourage people to understand is that, yeah, when people save a ton of money from not driving to work, from not taking trips, there's going to be a lag effect for economic hurt. But once people run out of money, I mean, this is what, again, keeps me up at night, is that the Fed, for some reason, doesn't seem to be allowing for that or understanding that. So they're like, oh, the jobs numbers are strong, so we're going to continue to hike, you know, this and this. But I'm telling them, like, at some point, you are going to see the consumer run out of money, and that is going to kill the economy fast.
Even though we are technically in a recession ever since the GDP reports came out, some analysts believe it isn't a true recession because the jobs number remained relatively stable. However, Gareth says that all the savings people built up during COVID will run out at some point, and that will be the catalyst for a fully fledged financial emergency.
So for me, I think Brazilian stocks, the EWZ is an ETF that tracks. It looks like it's breaking out here. I've been a big talker over the last 6 to 12 months about how people and institutions have overinvested in the US because it was the safest spot during COVID, so all this money came in, and they're underinvested in foreign markets, right? So you could even talk about China, although China has taken a big hit lately, but I think the EWZ is a beautiful chart, and I think people want to start looking other places. If we're going to be in a long-term, and I told you this last time, I truly believe we won't see a new all-time high in the stock market for 10 years. Yep.
Gareth reveals that he is bullish on gold and foreign stock markets because lately we have seen the US financial markets get saturated from foreign investments. He thinks there's a lot of potential in the EWZ as it looks very promising even during times like these.
Yeah, I think it's going to be these trusty stocks like an Apple. And again, percentage-wise, maybe not, but I think people will be shocked by how much more downside Apple can have. I have a price target under 100 on Apple for probably the next 12 months or so. And again, it's trading, last I checked, I think 140s or so. So you're talking about another 30% downside move in Apple. All tech stocks will be affected, but I do think there are certain growth names that are smaller that have already been trounced 80, 90%. And those could see a little bit of a less downside. And again, keep in mind, everyone has run towards Apple, Tesla, these trusty stocks, including institutions. They've overinvested because it was supposedly the no-lose situation. And I do worry that there's going to be an exodus in those names, which, by the way, you have Apple dropping that much. Think about what the Qs could do, the NASDAQ 100. I mean, you could see some major downside in those names. So I just want people to understand is that you go back to pre-printing periods, which is a long time ago now, you had companies like Apple in the past, like the Apple of its time, trading at an 8 or 10 PE ratio. Where's Apple? Apple's still in the 20s in terms of PE ratio. So I mean, if it ever comes back to this mean or medium point, you're talking about a lot of downside potential.
According to Gareth, tech stocks in general will be negatively affected in the next 12 months, but Apple in particular could be the worst performing stock among all. He has a price target of under $100, meaning another 30% drop from current levels.
Yeah, and I think they won't want to do, I mean, if they've done 75 3 times in a row, it's unlikely they would now jump, because that would really freak the market out to go to 100. So I think you're going to look at 70, or if the CPI data and the economic data shows that we are seeing a lowering inflation number, then maybe you get a 50 in there. I do think that a lot of other central banks, like Bank of England, we know they've stepped in here. There's a lot of concern out there from other central banks saying, hey, Fed, you're doing this too quickly. Our economies, our currencies can't handle. You're going to break us. I mean, we kind of did see that in the UK.
Right.
Since the Fed has hiked interest rates by 75 basis points 3 times in a row now, Gareth says it is highly unlikely that we see them jump up to a 100 basis points because it will cause mass panic in the markets. A more possible scenario is that they continue to raise rates by 75 or 50 basis points because the global economy is at stake, as we recently saw the Bank of England stepping in too.
There was rumors just a couple weeks ago or a week ago about Credit Suisse having issues. And the thing is that, you know, the Fed has enabled the financial sector to do a lot of the same things they did in the last financial crisis, right? I mean, it's almost like no one's learning from the rules. I mean, even Dodd-Frank kind of got pushed under the rug a little bit. And that just, I mean, so it's like the short term, everyone's just focused on how can we be the most robust economy in the short term. Well, guess what? Eventually that breaks, and that is an issue for sure.
It looks like 2008 all over again, and it appears as if the Fed hasn't learned anything from the past crisis. We are already hearing about Credit Suisse Bank, and if it really is facing financial troubles, then it is a huge red flag, and we need to be prepared for what's coming.
Everyone thinks a pivot is where they start dropping rates. Yeah. My pivot is where they go from 75 to 50. So it's like the downsloping mountain versus the upsloping climb.
I'm talking about just straight up stopping raising rates.
So just going to neutral. I do think by 2023, early first quarter, they're done. And I think you're going to see the jobs numbers. At some point, these jobs numbers are going to crack, and we're going to see a big drop and a fast drop. And again, this is going to coincide with people running out of this COVID savings and all of a sudden really pulling back. And think about 401ks. Think about your house. Like, as we see the housing prices fall, and we're starting to see that now, the wealth effect disappears. And people feel like it's one thing to say, I'm going to go buy a new car because my house just went up 100K in the last 3 months, and you know what, the economy's rocking. But now all of a sudden your house drops 100, 200,000, and you have other factors that are pulling you back. Now you just put on the brakes and the cliff dive occurs.
It is obvious that the Fed will have to pivot at some point. However, that doesn't mean it will shift to reducing interest rates all of a sudden. For Gareth, it means that they will increase rates, but by fewer basis points. We have seen the Bank of England kind of do this, as they are now reducing their quantitative tightening. Thank you for watching this video. Please drop a like and subscribe to our channel so you can keep watching educational content like this on a daily basis. See you guys in the next video.